Good morning. Welcome to the Brew. I'm your host, Lex. And today we are going to take a look at a covered call strategy. Very simple, great way to generate some income. We're also going to talk a little bit about the types of moves that are available for underlying assets and get a look at, just an intro look at the types of spreads that are good for all those types of moves. So stay with us. Opening bells right upon us. Mal, hello.
Good morning, Lex.
Good morning. You're always cheery at 5 a.m. in Peak Coast time, aren't you?
I think we should really harvest this covered call this morning.
Ooh, geez, that's a theta harvest question. Wow.
Let's just jump in.
I have my my coffee today too, so that's good news. I might say it 1,000 times. So we're going to talk about a covered call strategy today. That's going to be the main topic, right? But first, I wanted to show a little something about the types of moves and options. So a colleague of mine once said this to me, which I thought was interesting. So stocks can move in, I think he said, one of 5 ways. I'm trying to make sure I've got 5 of these written down. And I'm thinking about, I go, one of 5 ways. They can go up or they can go down. What are the other 3? Well, he kind of defined inside, up, and down, and what that means. And options are specific here because it's important to understand what could happen. So let me go to the remarkable real quick. Let's see if we can get that up here.
And while you're pulling that up, we'll just touch some news this morning. Tesla got a bump up. They were I think heavily suppressed for a long time, but they've received some thumbs up from Morgan Stanley and I think JP Morgan, but I could be wrong. I need to check on that, about Dojo. So a lot of positive talk about Dojo.
Okay.
And S&P looking risky, says so also Morgan Stanley being very vocal this morning. So we might want to take a look at that and give, at the end of the show, maybe give some pointers to some newbies of how to manage that if they're tracking that stock. And then we've got some calls coming out, some earnings coming out this week. We've got Oracle, Nike, and so we'll keep an eye on those. And yeah, that about wraps it up this morning. So covered call. I love the remarkable. Got
arrows. The remarkable's back. So here's the types of movements, and one of these fits in with the covered call strategy. Okay, so this person told me, he said, look, stocks can move up or down violently. He's going to count that as 2, up being 1, down being the second one. But violently is important. What we mean by violently is it goes fast and it goes hard and it goes big and aggressive. Those are big, big moves. So like an earnings type of play. So that's number 1 and 2 up here. Okay. The second one, up or down mildly. Okay. It's kind of like hot sauce, right? We got super hot. We got kind of mild.
That's great.
It doesn't move. They just kind of waft up, waft down. And what I mean by waft, it just doesn't do anything very aggressively. It's just kind of, just a summer day, just kind of the wind breeze blowing the stock up, blowing it down, right? That's moves 3 and 4, right? And I guess the last move, which this gentleman considered to be number 5, it's only 1, is sideways. So what does sideways mean? It basically unchanged. It just kind of doesn't move up, doesn't move down. It just kind of sits there and rots away, right? So the point of this matter is options are good for this one here. I mean, selling options, I should say. Selling options is good for these 2 and this one. So 3 of the 5 of these are really good selling options.
And just for audio only, which ones were you pointing to?
Oh, you can't. I'm trying to check them. Okay. So So I am the middle, the up, down, mildly. Great for selling option strategies or collecting theta, harvesting theta. Excuse me. 1 second. Very good. Sideways. Obviously, if you're selling premium in sideways markets, you're going to be collecting that stuff. I don't want to drink it.
Yeah.
So that's good. The tough ones for selling premium, up or down violently. That's the big NVIDIA move. right?
Yeah.
Up 30, 50 points. It's up some goofy number, some goofy percentage. Those are good for explosive convexity of options when you own
Ooh,
them, right? You
convexity.
own them.
That might be a
So
drinking game.
that's right. We might have to drink on convexity one of these days. So the covered call strategy works for both of these here, right? It's a great strategy when when you own some stock and you believe the stock is kind of in its kind of retracement stage or just kind of consolidating. Let's say it's kind of sitting around doing nothing. You don't really think it's going to go much higher or much lower for that matter. It might waft around, it might be sideways, it might grind up, it might grind down. All good things for doing a covered call strategy. We'll break it down in a second. Okay. So, options, selling options, and I'm a big fan of selling options safely. Okay. So, we can go back. We don't need to
Bravo.
now. So, let's go
Yeah.
back to just the two of us. So yeah, so selling options safely. What do I mean by that? When you sell options, you can either sell them naked, that means without your clothes on, or you can sell them with protection. Not even going to say what that means, but you can imagine. Um, so,
I'm
uh,
just gonna drink on that one.
yeah, you're just going to drink on that one. So, selling naked options means you have no protection on the short, right? So, you have unlimited upside and technically unlimited downside of your naked short options. Now, downside I know goes to zero, right? The stock. So, there's
You
someone's
can
gonna say,
lose
"Well,
your
you
shirt
can
on
only
that.
go to zero."
Yeah.
I get it, but
Right.
let's pretend that's unlimited anyhow.
And oftentimes when you're telling friends and family, I got into options, it's this great thing. They say, "Oh, don't go there. You'll lose your shirt," because they only know that one side.
Right, that's right. But my point here too is that, you know, I think I've said this before. I didn't learn how to really make good money in options until I learned how to sell premium. Selling premium means you're selling options, okay? You're not buying them, you're selling them. Now, clearly, to be protected in selling options, you have to have a long against it. So when we get into selling options, the strategy, especially off floor for me, is having risk defined strategies and incorporating an option selling sort of component to it so that I'm
That
collecting
discipline.
and harvesting data. That works because why does it work so well? Your risk is big, violent movement up and down. Totally understand that, right? Part of the game. You're not getting out of this options trading thing without some sort of trade off, right? There's always a risk to the other side of the position, but that's okay. When you define your loss, you know exactly what it can be, right? And you've accepted that loss, and now you're going to take advantage of the premium selling game to generate some income. So the first strategy we're going to look at that works great in three of these five kind of market type movements is the covered call. You brought that up this morning. We're going to talk about that.
Yeah, and if
What do you
and
know about the covered call? Do you know anything about the covered call,
y-
Mal?
yeah, and I was going to ask you a question on what you just said. When you're selling premium, touch a little bit more on that parachute that you would build. So you don't want to get stuck having to, having
Yeah,
an unlimited. So how do you cap your loss? How can you be ready to buy a stock at a cheaper price if that thing flies up?
yeah. So what happened with the way the defined risk strategy works is what we call a complex strategy, meaning there are multiple legs to the strategy. Okay, so the most common sort of premium collecting, theta harvesting sort of strategy is a credit spread. So you can sell a call spread, sell a put spread. If you sell a call spread, okay, you're selling a certain strike of a call and you're buying a higher strike of that call. That's going to create a credit. That credit is what you can make. Okay, that's the maximum amount of profit that you can make in that credit spread. The maximum loss is the difference between your strikes less the credit. Okay, and we'll look at some examples when we
And
when
that
we
and
look
that
at.
allows someone to and I careful to use this word after yesterday, leverage their capital. So they allows them to get more into the game because you're not buying the stock essentially on that first
Yeah, you're using
go.
credit spreads. Look at most of them that you do. You're not doing them on stock. You can, but you're doing it for a reason. You think that the stock is probably going to waft lower or go lower, so you're taking advantage of a short delta spread by selling a call credit spread. You're also taking advantage of collecting premium and letting that sort of rot away as time goes on. So again, several things good can happen in that type of a spread. And that's why I like them so much, because I know what my risk is. It's defined, right? I've got my belts and suspenders on because I've got a short option and I've got a long option, right? So they're going to net each other out. I'm going to lose the difference if that happens. Totally lose the difference, less my credit. So what's prescriptive? The bigger the credit you can get for those spreads, the better off you are. Applied volatility is at a certain point where you can grab a good bit of premium and it makes sense for the width of that spread. I love doing it, right? I love doing those kind, right? Oh my God, we're talking. Someone's asking about harvesting premium. Look at that, unbelievable. We can't drink again. We'll get to that in a second.
For us.
Yeah. So I can't stress enough the protective side of this. You're going to sell something, make sure you buy something, okay, to offset it, right? So the way you can sell something without protecting it, just sell a naked call, sell a naked put. If you do those together, same strike, it's a straddle. If you do those together and they're different strikes, strangle, okay? With just the shorts on, they're naked straddles, naked strangles, depending on the strikes you pick, okay?
And that'll be
Those
a
have
great
unlimited risk on big moves, right?
Yeah, straddles and strangles will be a great show of how that dance with when the Fed
Yep,
is changing rates.
that's
That'll be
right.
a nice show.
Yep. We're gonna go through all these strategies. So in the upcoming episodes, I think we're gonna start maybe not next week, but the week after, Mal. We're gonna start options 101. We're gonna take it from the very beginning, and we're gonna go all the way through. We're gonna talk about all this stuff. We're gonna get into synthetics. We're gonna get into all the strategies. Which ones are good for the violent moves? Which ones are good for the mild moves up and down? Which ones are good for sideways?
And so
we'll get. Yep. Go ahead.
yeah, so if students are learning and they're just getting involved, they'll be able to go to the hub because we'll have that all organized as a
Yep.
little bit of a simulation education. So if you're starting off with a covered call, you can go right in there. But if you're all the way over to straddles and strangles, you'll have that little
Yeah.
section to deep dive with Lex too.
I hope you have the ability to put it into chapters, Mal. Let's just put it that way.
I know, right? I'm blind. We'll see.
No, it's the way I learned the business is I had a great mentor. He hired me when I was a young college grad.
Can we ask his name?
No, you can ask his name, but I'm not going to tell you.
All right.
Privacy, I got all the privacy stuff.
Fair enough.
No, but he was awesome. He was one of the greatest teachers and really smart. One of the kind of the pioneers in the business too. So anyway, his first line of teaching always centered on synthetics. Okay, and I'm not even going to get into that today, but we are going to talk about it. So synthetics are combining options to create the same thing as a call or the same thing as a put or a long stock. There's all kinds of synthetics and options, right? So it gets a little confusing. That's going to be more in the advanced phases of this, but we're going to break our. Go ahead.
Yeah, things are only confusing when you're first jumping in with anything, and then once you really get a grasp of it, and practice makes perfect. You're like, that's it. That's all it was, and then it becomes, this is going to be good. So when you're learning options, you kind of start from unconscious incompetence. And you're going to take that all the way to unconscious competence. So it becomes like tying your shoelaces. And you can hear Lex talking these shows. You can get there, and you will get there.
You will get there. Trust me. It seems overwhelming. The biggest thing I get from folks, especially when they get into one of these advanced platforms like a Trade Hawk or some of the other ones that are out there, the beginners look at it and go, "Oh, what am I going to do? What is this? Look at all these numbers and all this stuff." Right? There's so many components and there's so many things to click on, blah. It's just mind numbing, right? But don't forget, options have so much variety and there's so much nuance to options. Think about all the Greeks, right? And now they've discovered sub Greeks and then they have subs of subs. And I'm like, where does it end? Now, do you need to know and become an expert in every part of that? Not really. Not as a retail person. You really don't. The best thing I could tell you is discipline solves the day, right? And then homework solves the day. And don't forget, the education is important too. You got to do your homework when you're an off-floor retail trader because you don't have the ability, and I say this over and over again, you don't have the ability to buy the bid and sell the offer. You are the opposite person. You're typically buying toward offers and selling toward bids. What does that do for you? In the instant in time, it gives you a negative edge. Okay. It's negative. That's the market maker's edge. That's okay, especially if you have a directional or premium type strategy that you are going to be really, really disciplined about. And you're going to have your protection and define risk built into the strategy as well. Okay.
Wow,
Can't
I
stress
love
it
that.
enough. If you can get all
Yeah.
that and be disciplined, know where your exits exist, where your entries might exist, you can make a really good run at this and generate income. Okay.
And just to an analogous example, so you take a 3-year-old and you can hand them an iPhone and they can download apps and figure it out.
Yep.
And when a grandparent coughs around their grandkids, the grandkids pops open a laptop and searches, symptoms and can go on PubMed and try to figure out what's going on with granddad. So
Yep.
and grandma. So there's an evolution that's occurring with personal finances, and we're watching it. It's happening now. We're witnessing it. It's exciting, and so this is something that will confront you and reach out and grab it because it's attainable.
Yep. It really is. It really is. So let's start off with one of these strategies today. Let's finish up with the covered call. I think I can get through all of it. So a covered call is a great income strategy. What is an income strategy? It means that as months go on, days go on, the option part of it is going to attempt to generate some income. Okay. So how do you do that? You got to sell something, right? Again, when you sell something, options are wasting assets. They decay. We call it decay. They get cheaper and cheaper and cheaper as time moves forward. Okay.
Okay.
What's great
And
about that? Weekends. Not only do I love weekends for margaritas and
just
swimming in the
right,
pool, but it's
right,
also you don't trade on Saturday and Sunday and Friday night. So theta occurs over the weekend, and options are actually decaying from Friday to Monday, and you can't trade them on Saturday and Sunday. So you can't hurt yourself. So that's the
right.
beauty of having that premium in your favor by selling it, because when you get to weekends, it's wonderful. I always used to love weekends
Yeah.
because A, I love weekends, and B, theta was working for me. Isn't that wonderful?
Right.
So the covered
Just,
call
just to
strategy. Go ahead. Sorry.
Sorry, Lex interrupts. Just a quick pause. Could you just define what off-hour trading is, just quickly?
Off hour, it's so the standard hours of trading in US markets for options is, I'm going to use Central Time because that's where I live. Central Time, 8:30 a.m. is when the market opens, the option market opens. Okay. Closes at 3 o'clock p.m., except for the indices, a bag of indices that close at 3:15. Okay. But the stock market closes regular trading hours at 3 o'clock. Now, post market is after 3 o'clock. They have post market
Yeah.
hours for stocks, and then pre-markets before 8:30 a.m. Central Time. And you can absolutely trade during those hours, but the main part of the day is that 8:30 to 3 o'clock segment. Okay.
Okay. Thanks.
Yeah. And there's talk, and we won't get into it today, but there's talk of going 24 hours and all that kind of stuff. I would
Yeah.
tell you too that people ask me, Lex, you don't have pre and post market options and blah blah. You don't want to trade options and pre. They're gonna skewer you, and it's so thin and illiquid during those times. I'm very hesitant to tell people to go trading after the market closes and before. Now, if you have a big gamma position, again, people are saying, what the hell is he talking about? If you have a big position where you're making money because of a post-market move, earnings, whatever it
Right.
may be, news, hey, you want to hedge your deltas? Great, have at it. Especially if you're making money, but on those things. But typically, I don't like to be in the aftermarket. Just me.
Noted.
Okay, back to our covered call strategy for harvesting theta. Um,
I'm drowning here. I'm
you're
drowning.
drowning over here. So what we typically do is what most investors have, right? They own stock, right? They typically not shorting it, but they own it. So they own 100 shares of XYZ stock, whatever it is. You fill in the blank what XYZ is. It could be Amazon, Tesla, Apple, you name it. So you love this stock for some reason, right? And you own 100 shares, let's say. So options Every single option is for 100 shares of stock. So if you buy one option or sell one option, it controls the equivalent of 100 shares at expiration, right? Whether you're getting assigned or you're exercising, right? So if you're
Called a
long,
contract.
that's right,
Called a contract. Yeah.
called a contract. If you're long 100 shares of stock, you would do a covered call by selling one of the calls on that stock. Now, which month do you choose to sell your call? And why are you selling a call? You're long the stock, you're selling this call. The call is a short. It's got premium to it. You're typically selling, at the money call, maybe slightly out of the money call. And again, that's a preference and an analysis that you as the investor trader have to perform, because you got to decide, hey, how much upside do I want? What do I believe in the value of this upside is? And then when you figure that out, 1%, 2%, 3%, you can take that 3%, find the call strike that is 3% higher, check to see if the premium is valid enough, sell that 3% higher. Now you've got a run of 3% up to that short strike with a covered call, right? Above which you're going to be taking out, because when that covered call, the short, goes in the money and expires there, that you're going to get short shares that are going to offset your long shares in your portfolio, and they're going to net to be zero. Okay. And you're going to no longer have a position. Now you can get around that by rolling the call up and out. All those kind of things can happen with short calls. But the idea of this covered call is whatever you're long in stock, you're going to sell equivalent number of options, right? And then you're going to collect that premium. As you collect that premium, you're going to pull it in. What is that called? Harvesting. And then you're going to roll it out to the next month, or up in that case, up in strike, right? If the stock starts running up to your short. Does all this make any sense at all?
Yeah, and since we're just starting out, so we're just we're pulling out the plane on the tarmac and we're taxiing off to education. So when you're long a stock, this is just, you're just getting in, when you're long a stock and you're holding a stock, you're in it for the long term. And then when you're
Right.
selling a call and it's a short position, it's because you could potentially when you sell that call, unload that stock. And so it's considered a short because you're in it for the short term if that expires.
That's
And
right. That's right.
yeah.
So I'm drawing a little thing on the
And
remarkable.
while you draw that, anyone who has stock options, who's
Mhm.
just sitting on stock and who has access, say
Yeah.
they're vested, you can actually collect some rent, which is what selling a call is. You can actually collect
Yeah,
some rent.
you can. What's
Yeah.
the downside? Let's go to the remarkable real quick. I can show you this. So I just drew this out. What I just said. I'm long 100 shares, right? And it's XYZ stock. It doesn't matter. Fill in the blank there. I'm going to sell one call against those 100 shares. Those net out to be zero, right? One call controls 100 shares, right? And I'm selling it, so it's short 100 shares on the call side, right? The stock is $55. And again, I just made this up. XYZ stock is trading $55. So this is where I own it, my 100 shares, right? Let me write that in. Oops. Shares. Okay. I'm going to sell one call on the 60 strike. I haven't picked an expiration. Let's just make it generic for now so we understand. I'm selling one call on the 60 strike. Okay. I'm collecting $2 for that call. And again, I made that number up. It's pretty high volatility, quite frankly, unless it's way out in time. Okay. So that $2, remember, everything's times 100. So $2 is 2 times 100. It's $200 I can make on this position with that short call. So there's $200 over time that option has to decay down to zero or to parity if it goes in the money, right? For me to collect it. And every day it's going to decay a little bit. So the income generating part is day one, it starts at 2 when I sold it. Day two, it might be at 190. Again, I'm totally making this up, 197. Day three, it might be at 195, and so on. And it's not arithmetic, it doesn't go step down perfectly. It starts slower, depending on the time. And as it nears expiration, we talked about this yesterday with zero DTs, it craters, it collapses like one of those plastic water bottles when you crush it on the last few days, right? Now, you're probably not going to hold this call to the end. You're going to get some good income out of it, right? And then you're going to roll it. And you're going to do it again in the next month and then the next month. And that's what income generating strategies do. You do this systematically. You're selling a call against your long stock. You're collecting that premium each and every month, right? If it breaches and runs up, you're long the stocks, you're good there, and you're going to get stopped out at that 60 strike. plus this $2 credit, right? And then you decide.
And yeah.
Go ahead.
And you as a market maker talked about how it's a crumb collection. So although it's not the visceral uptick that a lot of people really want, when you have that discipline, as you talk about, it's just this and that flow and that systematic maneuvering. It's just this nice crumb collection. So 200 over time adds up. It's and
Sure. Well,
compounding.
yeah, you can imagine, the numbers are, you can put any value to this number, right?
Right.
So I just used
Yeah.
100 shares. What if you had
Right.
1,000 shares? Now it's
Right.
2,000 bucks
Exactly.
or
Right.
10,000 shares. It just
Right.
it grows based on the size of your wallet. If you have a
Yeah.
big account, you're going to do probably a little bit more. But this is a great strategy. I love it. And look, I would tell you that in the pro side of my life, when we're on the floor, we did covered call strategies all the time. Now, did
Wow.
we do them as covered call strategy? We go out and say, "Hey, I like Apple stock. I want to buy it, and I'm going to sit there as a professional and sell options against it." Not really. We would have long and short stock positions based on hedges, and we'd have all kinds of positions. But we like being in positions where we could be long some stock, long some downside put, short some upside calls, kind of like a collar, kind of like a covered call, and always be collecting some premium in our inventory. So we did it all the time. We didn't do it
Got it.
consciously. We didn't say, I'm going to do a covered call strategy now. We just did it as hedges, and it worked out to look like that covered call. So we're going to lead with this, and this is back to my synthetic from the very beginning. When you own 100 shares of stock and a short one call against it, okay, and let's say in this case it was the 60 strike, that is the synthetic short put. Okay, that's what that's called. Now, no one probably thinks of it that way, but it's equivalently the same as being short the 60 put in our example. Exactly the same. Okay, so we're going to break that down at a future episode to see why those are the same and why it's important to understand that they're the same. Okay, because you can hedge that risk perfectly by buying the actual put at some point if you'd like, or take the position off. But that's a covered call is a synthetic short put. Okay.
Got it.
You had a question, Mal? Sorry.
Yeah. So a caller being we'll touch more on covered calls. I think you're doing a whole presentation, but slides, you've got some fun stuff coming. Caller being the next approach, with the S&P and being announced that it's a little bit risky. What would be would you put a put somewhere in there? Would you collar that covered?
Yeah. So remember our belts and suspenders, right? So if I have a short put in this example, a synthetic short put, I am what's considered naked in this scenario. Now,
don't stand up.
I'm not going to stand up.
Stand up.
I'm not standing up. Probably in the retail world, if you own that stock, you actually own it. So you had to have enough margin to cover that stock down to zero. Okay. So that's the likelihood that, with that, unless you're getting massive leverage somewhere. So you probably have enough money to cover that move down to zero. So is your risk, you've already defined your risk because you're paying for it, right? So you've paid for it down to zero. Now you've just added some juice to the short call and give you a little income on it as well. So, you've kind of covered yourself. To really cover yourself, you could buy a downside put. Now you're into that collar. You've got the short put version of it, right? With the synthetic long stock, short a call is a short synthetic put. And then you buy an actual put beneath it. And now you're into technically a put credit spread again, right? Synthetically. So we're going to have to draw that out. We're not going to do it today. We're running out of time. And that's why it's so important to understand the relationships of all this stuff together, because people don't understand that when you have the collar on with the stock in between, it's really just a put credit spread is what it is. That's all it is.
So, and I remember on a show you said you do not like trading SPY, so which follows the S&P 500. That is not your favorite, correct?
I got two answers for that. As a market maker, I would probably hate to trade SPY because the markets are a penny wide and there's no edge for me as a market maker. Yeah. I'm only, I've got a difference between a penny. So how much value can there be there? So that's why I don't like it as a market maker. As a retail person, I love it because it's a penny wide and I don't have to pay a lot to get into the market. So my bid ask is a penny. That's de minimis, right? To get in and out of a trade for a retail person. So I love tight liquid markets for retail folks. For market making people, we typically did not like that. We would like wider markets because we're buying bids and selling offers all day, right? right?
So we'll talk about option trades that maybe can ride the S&P 500 down using SPY, which could be fun
Yeah, for
for a
sure.
new guy.
Yeah, spies are great, and there's SPX out there, there's SPY, there's all kinds of
Yeah,
products that mirror the grander markets. And you can do these covered calls. You can do them in indices. There's a little trick to it. Again, we're running out of
ooh,
time, but there's little tricks to these things in indices. And again, it's just combinations of options that are synthetics that create the real thing, right? So you can do all these kind of cool spreads, so that you essentially affect owning the SPX. Quite frankly, you can't buy the cash index, right? And you're
right,
not gonna, most people aren't gonna have enough money to go buy 500 stocks in the right ratios to own it, but you
correct.
can do it with options. So it's pretty cool. And we'll talk about it next time.
And
Um,
then
Go
last
ahead.
thing I want to say, you will get the options bug when you have your first aha moment. There's no climbing out. Once you're in, you get hooked.
Yeah, it's
So
you know
and this
what
stuff gets fun.
that's a really good comment, a good point. I think you're right. I think the hurdle is getting over the beginning part. And that's what we want to do with this series of beginner 101. And we're going to start from, when we do this, we're going to start, what is an option, what is a call, what is a put, what's a strike price. We're going to start really basic. But as we build it, it's like building a building. We're going to build a foundation. We're going to keep putting blocks on it. You're going to find that there's some really intricate, crazy things that you can do, but you don't have to. And I always tell folks, find something that fits your personality with options, right? Your risk threshold, your risk tolerance, your capital, all that kind of good stuff. Find something that fits your personality, and make a trade plan and system that is disciplined and you stick to, right? It can work. It really can. You just have to stick to it. And look, if it's not working, you're losing money because you think you're disciplined and you think you're doing the right things, you got to keep pounding, you got to keep back testing, you got to keep trying, because there's probably one little flaw that you're missing with the strategy, right? So
And
you really,
if you find yourself in that situation, come on the show, ask a question. If you're
yeah,
stuck somewhere, you can, Lex is right here. So
that's right.
that'll be exciting.
We do private demos. I don't have the link for that. We'll put that in next time.
Okay.
We
Well,
can
no,
get
we'll
on
put
a,
it in the show notes.
yeah, no, that's good.
Okay.
So anyway, it's a building process, and you may not get into options, 505 down the road. The real advanced stuff might not even be meaningful to you as a trader or as an investor. You might just stay with covered calls and buy on a protective put. That might be as far as you go. Perfect. Doesn't matter. We don't have to be complicated. It doesn't have to look fancy. It doesn't have to be pretty. It just has to work, and you have to, just keep doing it over and over again, right? So I'm
And
not
that's
going to say theta harvest again. God darn it, Mal.
I'm running out. Running out.
All right. So
Thanks.
yeah, we're running out of
Thanks,
time.
Linda.
Let's go over to the markets real quick. Let's see I'm just curious what's going on here.
And for what you just said, for those who just stick to cover calls, I would say value traders who just really want to love a product, love a company, love a CEO, and they just want to get in and collect some rent and get involved, and that's good too.
Yep. No, that's exactly right. And that's part of the doing your homework part of the equation. You have, as a retail person, you have to do a little homework, unfortunately.
Yeah,
And you have to understand the products you're trading a little better than we did as market makers. I didn't know what products I was trading. Didn't matter. I could
which
be
is really
trading.
interesting. No, I didn't. I
Yeah.
never knew that. Yeah,
Yeah, no, I could be trading, dog poop in Amazon in Amsterdam. It didn't matter. As long as it moved up and
right,
down and sideways, I
right,
could care less. Did not
right.
matter. That's not true for the retail folks, though. A little different. So this
Yeah,
is
it
one of those
changes.
days of the 5 moves that we discussed. This to me is a slightly down day at this point. So this is, the dot down. If you're short premium in this environment right here, safely, we're having a good day. Depending, again, assuming you're not massively long deltas on a down day, right? So, and I'm a big delta neutral guy, but that's just me. So
And then
all good.
I think where there's word that gold seems to be, I think that it had a short day yesterday. I think that you'll see that happening when there's talk that on the next Fed raise that they may not raise. They might just pause for a moment, even though we've had a lot of hikes. So we'll keep an eye on that too.
Yep, absolutely. Keep an eye on that. Perfect. All right, Ma. Well, that's about all the time we have today, and my Remarkable is running out of
Thanks,
battery.
Lex.
I do like this
You,
Remarkable.
I know.
I just got a new cover for it. It's like this little leather bound cover.
You've accessorized.
I did.
Oh
So
my
now
gosh. You just up leveled.
so protected. See, protection. We're gonna do a little episode or a little snippet from High Upon the Mountain one of these days about straddles and strangles. You'll see.
That's gonna be fun.
All right. All right, Molly,
All
you have
right.
a good
Thanks, Lex.
Tuesday. You know what Tuesday
All
is
right.
for me? It's Taco Tuesday. I'm trying to work up my taco meat for later. I'm
I
not sure
love
what it's
it.
going to be yet.
Technical Taco Tuesday.
I love
Let's
it.
do this.
All right.
All right.
All good.
Bye,
I'll
Lex.
see you tomorrow on the
Okay.
Brew. That's a wrap.